Well, hello. Very good to be back with you again. I'm Nicholas Bohnsack, President and Head of Portfolio Strategy for Strategas, Baird's investment strategy arm. While the markets seem to have largely turned its attention away from Washington for the last several weeks, even SNL managed an entire show without a political sketch, Washington now appears to be back at the center of things as Congress moves to pass yet another fiscal package. This one appears to be clocking in at nearly $1.9 trillion. That's notable, not just for its size, $1.9 trillion, but following so shortly after the roughly $900 billion package that was passed in late December. All in, that's nearly $3 trillion of fiscal stimulus in a little more than 7 weeks. That's big money. So where's it going? Well, there's $450 billion in checks to Americans, and $350 billion in state aid, $350 billion in a further extension of unemployment benefits, and $100 billion to bolster the ranks of our frontline healthcare workforce. From there, the categories are only apportioned money in the tens of billions, but of course it all adds up. And it's a lot. Since the onset of the pandemic, roughly a year ago, and with this new package, the U.S. government will have passed more than $5.2 trillion in fiscal aid. That amounts to a little bit more than 22% of U.S. GDP. And as much as the virus very much remains our Scrooge, and we continue to wrestle with the gnawing tension between health and income, few would argue the merit of supporting our communities through these difficult times. In fact, the amount of state aid alone created a budget surplus in the third quarter of last year, and now another $350 billion is on its way. Of course, some will hazard political arguments opposed, and others will begin to soft-circle the day all this spending becomes a problem. But in the meantime, policy is reinforcing the bridge between a medical problem and the administration of a medical solution, and that's good news. What then when we cross that bridge, which is to say, what happens when the economy can and does begin to reopen in full? It would seem we've greased the skids with a form of modern monetary theory which will render the reversal from near unlimited spending rather difficult. An endorsement perhaps of the notion that politicians were put on this earth to give things away, and less so to take them back. Time will tell. But so does the prospect of inflation. And for the moment, though inflation is tame, prices as measured by the CPI rose just 0.3% in January and are running at about a 1.5% pace year on year, not outside the norm for the United States, and even a touch lower, frankly, than we saw in the several years before COVID. The concern rests on three horizons. The first is the potential that price data will prove increasingly volatile in the months ahead, as we begin to anniversary the onset of the pandemic. This seems reasonable given the way that the data are measured, but not altogether worrisome. Even Fed Chair Powell has suggested he'd be discounting these data. Of course, it will lead to heightened concern of an inflation scare, and due to the combination of continued profligate spending and in the midst of an economic reopening, remember, once we've administered the medical solution, do we still need so much fiscal accommodation? Probably not. But we feel the concern is becoming increasingly consensus. It's one of the reasons that we topped up our recommended allocation to gold in our global asset allocation. And so as the theory goes, if number 2 proves correct, then what is the risk of a protracted increase in inflation? We put it at low for now, but those who invested through or studied the 1970s know the effects of such a price regime. The policy levers necessary to quell such a flare-up leave much to be desired. So while we may be a way out from a runaway inflation scare, know that the Baird team is on the lookout for any concerning signposts. At the very least, we should have that conversation and put it all out on the table so we have a plan when we need one. Interesting times for sure. Stay sharp, stay healthy. We'll see you again soon.